Right now in Toronto, there are homeowners sitting on properties that have already lost 30% of their 2022 peak value. They are not in foreclosure yet. They are not panicking yet. They are making the minimum payments, crossing their fingers, and hoping the market turns around before their mortgage comes up for renewal. It will not turn around in time. And for 8 specific neighborhoods in this city, the math does not just get uncomfortable, it gets catastrophic. Hi, my name is Alexander, and this is Broken Canada, How We Got Here, the Toronto Bubble. Nobody wanted to call a bubble. Let me take you back to 2010. The average detached home in Toronto cost $431,000. That number sounds almost fictional now. A teardown in Leslieville. A bungalow in Scarborough that needed a new roof. $431,000. At the interest rates of that era, a household earning $90,000 a year could carry that mortgage without destroying their life. Then something happened. Actually, several things happened simultaneously, and the real estate industry celebrated every single one of them, while nobody talked about what they added up to. First, the Bank of Canada kept interest rates historically low for over a decade. Cheap money means expensive assets. That is not a theory. That is arithmetic. When you can borrow at 2%, you will pay more for the asset than you would at 5%. Every buyer in the market was chasing the same properties with progressively cheaper debt, and the only mathematical outcome of that dynamic is rising prices. Second, Toronto became a preferred destination for international capital. Wealthy buyers from Hong Kong, mainland China, Iran, and India were moving money into Toronto real estate, not primarily because they wanted to live there, but because Canadian property felt like a safe deposit box with a tax advantage. A condo in North York does not ask where your money came from. It just appreciates. Or it did. Third, and this is the part that the industry really does not want to talk about, the pre-construction condo market became a speculative instrument dressed up as a housing product. A developer would launch a building in 2015. They would sell units on paper as assignments before a single floor had been poured. Investors would buy those assignments not to live in the units, not even to rent them long-term, but to flip the assignment itself to the next buyer before closing. The building was a financial product. The housing was incidental. By 2022, the average home price in the Greater Toronto Area had crossed $1.3 million. A household would need to earn roughly $200,000 per year to qualify for that mortgage under standard stress test guidelines. The median household income in Toronto in that same year was $87,000. Read that again. Median income, $87,000. Required income to buy the median home, $200,000. That gap does not resolve itself gently. It resolves itself in one direction, and that direction is down. What changed the timeline was the Bank of Canada doing something it had not done in decades. Between March of 2022 and July of 2023, it raised the overnight rate from 0.25% to 5% in 17 months. It was the fastest rate hiking cycle in 40 years. The buyers who stretched to buy at peak prices with variable rate mortgages did not see a correction coming. They saw a mortgage payment that increased by $1,200 a month overnight. The investors holding pre-construction assignments discovered there was nobody left to sell to. The closing costs, the land transfer taxes, the development charges that had been added to the final price since 2015 meant that the assignment was now worth less than the original purchase price. And they were legally obligated to close. That is how you build a collapse. Quietly, over a decade, and then all at once, the collapse mechanism. What actually triggers a 65% drop? Before we name the 8 neighborhoods, I want to explain the mechanism. Because a 65% value drop sounds like a headline designed to scare you. It is not. It is the number you get when you apply the specific conditions present in these specific areas to the historical data on what happens to investment-heavy condo markets when three things occur simultaneously. The first condition is forced selling. This is not people choosing to sell because they found a better opportunity. This is people who cannot carry the asset anymore. Negative cash flow landlords, investors who bought a condo for $800,000, rented it for $2,200 a month, and are now paying a mortgage that costs $3,400 a month cannot hold indefinitely. Every month they hold, they are writing a $1,200 check to own an asset that is declining in value. At some point, the math forces the sale. The second condition is a broken buyer pool. In a healthy market, when a seller needs to exit, there is a buyer ready to enter. In these 8 neighborhoods, the buyer pool has 3 problems. First, end-user buyers, people who actually want to live in the unit, cannot qualify for a mortgage at current interest rates and current asking prices. Second, investor buyers have watched the rental yield collapse and are not entering. Third, the assignment market has dried up completely because the pre-construction pipeline is now delivering units into a market that is already oversupplied. No forced selling pressure plus no buyers equals one outcome. The price moves to wherever a buyer finally appears. And in these specific neighborhoods, that clearing price is dramatically lower than anyone in the industry is publicly admitting. The third condition is concentration. These are not diversified neighborhoods with a mix of housing types, income levels, and ownership structures. These are zones where investor-owned units represent 60, 70, sometimes 80% of the total housing stock. When investors all head for the exit at the same time, which they will because investors respond to the same data signals, there is nobody left on the other side of the transaction except a buyer who knows they have all the leverage. 65% is not a random number. It is the historical outcome for over-leveraged, investor-concentrated condo markets in comparable cities when all 3 of these conditions are present. See Miami in 2009, Dublin in 2010, Vancouver condo submarkets in 2018 and 2019. The mechanism is not new. Only the geography is. The 8 neighborhoods. Number 1, the North York condo corridor, Yonge and Shepherd to Yonge and Empress. Stand at the corner of Yonge and Shepherd and look in any direction. Every tower you see was sold, in significant part to investors. Not families. Not young professionals who scraped together a down payment because they wanted to build a life in North York. Investors. People who bought a unit the same way you buy a stock, with the expectation that the next buyer would pay more than they did. The Yonge-Shepherd corridor was one of the most aggressively developed condo markets in Toronto's history. Dozens of high-rise towers delivered units between 2012 and 2024. The sales centers were packed, the assignment flips were profitable, the brochures were glossy, and the entire thing was built on an assumption that nobody in the room wanted to question out loud, which is that the math only works if interest rates stay low and the next buyer stays desperate. Neither of those things is true anymore. Here's the unit economics problem. A 700 square foot, 1-bedroom in this corridor sold for between $650,000 and $800,000 at peak pricing. At current interest rates, the all-in carrying cost on that purchase, including mortgage, condo fees, and property tax, runs roughly $4,200 per month. The rental market in that same corridor is clearing between $2,200 and $2,500 per month for a comparable unit. That is a negative cash flow of $1,800 per month, every month. Not on paper, out of a bank account. And there are not dozens of units in this position. There are thousands. Now here is the part the industry does not want you to think about too carefully. The investors holding these units are not wealthy people sitting on paid-off portfolios who can absorb a temporary loss. They are middle-class Canadians who believe the mythology that Toronto real estate only goes up, that leverage is a strategy, that being a landlord was the path to the retirement their salary could not provide. They borrowed to the limit and bought at the peak, and they are now writing an $1,800 check every single month to own an asset that is declining in value. When that group breaks, and they are already beginning to break, the selling pressure does not arrive gradually. It arrives all at once. And there is nobody on the other side of that transaction at current prices. A family that wants to live at Yonge and Shepherd can rent the identical unit for $2,300 or buy it for $4,200 a month. That is an 80% ownership premium over renting. No functional buyer pool absorbs that number. The price has to move. The only question is how far. Number 2, Scarborough Town Center Radius. Scarborough has always been misunderstood in Toronto's real estate conversation, and the misunderstanding has become expensive. Between 2015 and 2022, a wave of new condo development targeted the Scarborough Town Center area on the premise that light rail transit expansion would transform the corridor into a transit-connected, high-demand zone. The transit has not arrived on schedule. The demand assumptions baked into those pre-construction prices reflected a Scarborough that does not yet exist. Units that were assigned at $600,000 are now competing with a resale market that has moved well below that number, and the buyers who would theoretically be attracted by transit connectivity are not yet here, because the transit is not yet here. The double problem in this area is that the rental market is thinner and more price-sensitive than the North York corridor. The pool of tenants paying $2,500 per month in Scarborough Town Center is smaller than it is at Yonge and Shepherd. Investors in this zone are not just cash flow negative, they face a rental market that offers less protection on the downside. Number 3, Etobicoke Lakeshore Condo Strip. The Etobicoke Lakeshore story is one of the most cynical chapters in Toronto's development history, which is saying something given the competition. The Lakeshore corridor from Mimico through Long Branch was marketed as Toronto's next great waterfront neighborhood, and parts of it are genuinely pleasant. The problem is that the development that followed the marketing did not deliver a waterfront neighborhood. It delivered a wall of investor-owned towers that blocked the waterfront from the communities behind them. Vacancy rates in the Etobicoke Lakeshore corridor have been quietly climbing since 2022. A meaningful percentage of units in newer buildings are sitting empty, not because nobody wants to live there, but because landlords are pricing for a rental market that existed 2 years ago, and the actual renters available cannot or will not pay those rates. An empty unit is not cash flow negative the way a rented below-cost unit is. But it is a landlord who is paying full carrying costs with zero income, and that situation has an expiration date measured in months, not years. Number 4, Regent Park and Moss Park redevelopment zone. This one is complicated, and I want to be fair to the complexity. The Regent Park revitalization is a genuinely ambitious piece of urban planning that has produced real improvements in a neighborhood that needed them. But the private condo component of that revitalization was priced on an assumption set that has not held. Market condos in the Regent Park redevelopment zone were sold at price points that reflected the anticipated neighborhood transformation more than the current neighborhood reality. The transformation is real but slow. The price premium was based on a future that arrives on a timeline measured in decades. Investors who bought in 2018 and 2019, expecting to exit in 2023 or 2024 into an appreciated asset, are instead exiting into a market that is assigned the transformation premium correctly, which is to say, it has not fully arrived yet, and the price reflects that. Number 5, City Place and Fort York. City Place is the cautionary tale that Toronto real estate professionals have been privately telling each other for a decade, while publicly saying everything is fine. This is the largest single master plan condo development in Canadian history. Over 11,000 units were delivered into a footprint that, at the time of construction, had almost no walkable amenities, no grocery store, no community infrastructure, and one school that was perpetually undersized for the population it served. At peak prices, a 900 square foot two-bedroom in City Place was selling for over $900,000. I want you to sit with that for a moment. 900 square feet, no parking included. Condo fees were $650 per month. Property tax was another $400 per month. Carrying costs at peak borrowing rates were approaching $5,500 per month. The building's mechanical and envelope systems are now aging. The first generation of City Place towers are approaching 20 years old. Condominium boards in this area are beginning to issue special assessments to cover deferred maintenance that was kicked down the road for years to keep condo fees artificially low during the sales period. A special assessment notice is not the kind of disclosure that attracts new buyers. It is the kind of disclosure that accelerates existing sellers. Number 6, Downtown East, the Jarvis Corridor. The Jarvis Corridor, running from Bloor down to the Gardner, was positioned as downtown adjacency at a discount, close to everything, priced below the core. That positioning attracted a very specific investor buyer, the kind who bought in 2017 and 2018, expecting that Downtown East would gentrify toward downtown pricing within a decade. Parts of that story are playing out, parts of it are not. The corridor still has significant social housing concentration, active shelter presence, and the kind of street-level environment that end-user buyers with choices tend to price carefully. The investor who bought at $600,000 expecting to sell at $900,000 in 2023 is instead looking at offers in the $480,000 to $520,000 range and trying to decide whether to take the loss now or hold through a recovery that is not on the visible horizon. Number 7, Jane and Finch surrounding area. I want to be honest about Jane and Finch in a way that the real estate industry is not. This neighborhood has been subject to decades of municipal disinvestment, a stubborn concentration of poverty, and a planning history that isolated it physically and socially from the rest of the city. The condo development that arrived in the surrounding area over the last decade was not driven by organic neighborhood improvement. It was driven by land cost, because Jane and Finch land was cheap, and developers priced units assuming buyers would accept the location discount. The problem is that the location discount has widened, not narrowed, as the market has corrected. In a strong market, every neighborhood benefits from rising tide dynamics. Buyers who cannot afford their first choice accept their second choice and bid that up. In a correcting market, buyers retreat to quality and location. Jane and Finch is not where capital retreats to. It is where capital exits. The investor concentration in new builds in this area is extremely high, and the end-user buyer base for these units, at current prices, is essentially non-existent. Number 8, Vaughan Metropolitan Center overflow. Vaughan is not Toronto. I know that. But the Vaughan Metropolitan Center condo market is so directly tied to Toronto investor psychology that excluding it from this map would be dishonest. VMC was sold to investors on the premise of subway connectivity and urban intensification. The subway arrived. The urban intensification is still mostly a rendering on a sales office wall. Towers at VMC were pre-sold to investors, primarily through the assignment market, at prices that reflected the finished neighborhood vision. The finished neighborhood vision is not finished. In the meantime, investors are carrying units in a market where rental demand is far thinner than projected. The promised retail and amenity base has been slow to materialize, and competition for tenants is fierce because every investor in every tower is fishing in the same limited pool. Now, the VMC investor is competing against a rental market in Vaughan that has also softened at a carrying cost that was calculated when interest rates were 2%. And there is no realistic exit to an end-user buyer who wants to own in this specific location at current prices. The pattern that ties all 8 together You have probably noticed it already. I'm not subtle about it. Let me name it explicitly because this is important. First, investor ownership concentration above 60%. These are not owner-occupied communities. They are investment portfolios masquerading as neighborhoods. When the investment thesis breaks, and the investment thesis has broken, the selling pressure is not one family deciding to move. It is hundreds and thousands of investors making the same rational calculation at the same time. Second, negative carry. Every investor in these zones who bought at peak prices with current interest rates is losing money every month. Not on paper, in cash, out of their bank account every month. That is not sustainable. The question is not whether they sell, the question is when. The more of them that reach the breaking point at the same time, the faster prices move to clear. Third, no end-user floor. In a healthy real estate market, even when investors exit, owner-occupiers provide a floor. They want to live there. They will buy at prices that are rational relative to income. But in these 8 corridors, the gap between current asking prices and what an end-user buyer can rationally carry at today's rates is so large that the end-user buyer floor is far below current market levels. The floor exists, it is just not where the sellers are currently priced. Fourth, the assignment market is frozen. The mechanism that allowed investors to exit pre-construction positions without ever closing, selling the assignment to the next speculative buyer, has stopped working. There is no next buyer. The exit ramp that the entire pre-construction investment model depended on is closed. Investors who expected to assign their way out of these buildings are instead being forced to close, carry, and eventually sell at a loss. That combination, concentrated ownership, negative carry, is no end-user floor, and a frozen assignment market, is the specific mechanism that produces the kind of value destruction we are describing. The 65% figure is not a worst case. It is the historical outcome for markets with these specific characteristics. Anyone telling you otherwise is either uninformed or has a financial interest in your continued optimism. What smart money is actually doing. This is not financial advice. I want to say that clearly. I am not a licensed financial advisor. I am a person with a microphone and access to data. What I can tell you is what sophisticated capital is doing right now based on what is observable in the market. You can do with that information what you choose. The first thing smart money is doing is buying time, not assets. Investors and buyers with real capital are sitting on the sidelines in the specific zones we have discussed. They are not buying at today's prices, because today's prices are not the clearing prices. They know that the forced selling cycle has not completed. The investors who are going to exit have not all exited yet. The special assessments have not all been issued yet. The mortgage renewals at punishing rates have not all landed yet. Smart money waits for the cycle to complete before stepping in, because catching a falling knife is expensive regardless of how sharp your financial reflexes are. The second thing smart money is doing is rotating into freehold, not condos, not stacked townhouses built on the same investor concentration model. Ground-oriented housing in established Toronto neighborhoods, Leslieville, The Beaches, Roncesvalles, Corso Italia, where owner-occupiers represent the majority of buyers and where land scarcity provides a structural floor. These areas have already corrected from peak prices. They have not collapsed and will not collapse in the way the investor-concentrated condo corridors will, because the ownership structure is fundamentally different. The third thing smart money is doing, and this is the move that almost nobody is talking about publicly, is looking at rent. Not as a failure to own, but as a rational economic decision given the present spread between ownership costs and rental costs in these specific zones. In a city where you can rent a unit for $2,300 that costs $4,500 a month to own at current rates, renting is not losing. It is arbitrage.
The difference between what you would pay to own and what you pay to rent, invested into something that is not a depreciating Toronto condo, compounds into a meaningful number over 5 years. That is not a consolation prize. That is the correct calculation for this specific market moment. I want to add one more thing, and I am going off script for a second because I think it matters. There is a psychological trap in the Toronto real estate conversation that has been extremely expensive for a lot of people.
It is the idea that renting is failure and owning is success. Full stop, regardless of what you are buying, at what price, with what debt load. That idea was manufactured and reinforced by an industry that profits from transactions. A family that rents a reasonable home in a stable neighborhood, saves the difference, invests consistently, and does not destroy their financial life chasing a peak-priced investor condo is not losing. They are winning. The scoreboard just looks different than the one the real estate industry wants you to use. The one rule. I said earlier that there is a pattern that ties all 8 of these neighborhoods together. Let me give you the one question that reveals whether a Toronto property falls into that pattern. Ask, who is the buyer when the current owner sells, not who could theoretically buy, not who bought similar units in 2020, who is the realistic end user buyer today, at today's rates, at the current asking price, who actually wants to live in this specific unit, in this specific building, in this specific location. If the answer is another investor, you are in a chain, and chains break. The entire pre-construction investor model in Toronto was a chain. Assigned to the next buyer, who assigns to the next buyer, who closes and rents at a loss, who eventually sells to the next investor. Every link in that chain was betting that the last link would be an end user who wanted to own and could afford to. That end user never arrived in sufficient numbers, and now the chain is pulling apart. If the answer to that question is a genuine end user buyer who can qualify for the mortgage at current rates and finds the price rational relative to their alternatives, you are looking at a structurally sound purchase. Those properties exist in Toronto. They are just not in the 8 corridors we have discussed today. Check the ownership concentration in the building. Your condo corporation's status certificate will tell you the ratio of owner occupied to investor owned units. If it is above 60% investor owned, you are buying into a building where the majority of your neighbors are economically motivated to exit, not to stay. That is a different kind of community than one where the majority of people chose to live there because they want to live there. Check the cash flow math at current rates, not at the rate you hope the Bank of Canada will cut to next year. At today's rate, if the ownership cost is more than 20% above the rental cost for a comparable unit, the pricing is not supported by real demand. It is supported by the expectation of future appreciation. And in a correcting market, future appreciation is not a financial plan, it is a wish. That is the one rule. Not complicated, just uncomfortable. Here is the bottom line on Toronto real estate in 2026. This city is not going to disappear. The demand to live here is real. The population growth is real. The long-term case for urban density in a major North American city is real. None of that is in question. What is in question is the price at which you buy into that long-term story, in which specific location, in which specific ownership structure. The price you pay on the way in determines everything about the outcome you get on the way out. The investors who bought in the 8 corridors we discussed today paid prices that reflected a version of Toronto that required permanently cheap money, permanently rising demand, and a permanently growing pool of speculative buyers to sustain. None of those things are permanent. Some of them are already over. The manufacturers of washing machines designed their product to fail after 10 years, so you would buy another one. The builders of new homes designed the warranty to expire before the problems arrived.
The automakers built turbochargers and direct injection engines with failure points they documented and then excluded from warranty coverage. And the Toronto real estate industry sold investor concentration condos in undersupported corridors to buyers who were told the only direction was up. The direction was not only up. If this saved you from making an expensive mistake, subscribe. Next time, we are going to talk about what the Canadian mortgage renewal cliff looks like when 450,000 households hit renewal in the next 18 months at rates double what they signed at. It is not a market correction. It is a structural event, and you need to understand it before it is already happening to you. This is Alexander. This is Broken Canada. And the most expensive thing you will ever do is trust people who profit from your optimism.